Hey, Jeff, thanks for joining me.
Hey, Steve, thanks for having me.
Good to have you. We were talking multifamily here as the sector comes out of 2023 and we moved into 24. We saw some interesting developments. A lot of demand last year, up 114% year over year in absorption of units, reaching 313,000 units and exceeding the 10-year trend. But we also saw vacancy rates moving to a new 10-year high at 7.4%. That was a 0.9% increase year over year. We also saw rent growth, though, bottoming at about a 10-year low with only about a 0.6% uptick compared to the 3.9% increase from the preceding year. We're seeing major urban hubs like New York, Washington, D.C., Houston, Dallas, Fort Worth continuing to have pretty robust demand. But we're also seeing rent growth deceleration in a lot of parts of the country with the exclusion of the Northeast. And we're also seeing some areas witnessing a bit of a downturn. Austin was pretty hot, and we're seeing that cool off. We're also seeing Fort Myers and Ocala, Florida, seeing some rent reductions. Some of your thoughts on a multifamily market that seems to be doing what real estate does, showing some differences across classes and across different metros in the country.
Well, I think it's kind of like all the stories we kind of review. It's the media telling us what is good and what's bad, and the truth is this isn't really bad news. It might be bad news for the people that were buying at the wrong cap rates and with low interest rates. However, I think in reality, people that were buying right, um, that continue to have low cost of low cost of debt are sitting in a better position. When you start looking at projects that were, let's call them Class B, Class C projects, and people bought them at a ridiculously low cap rate, and then are trying to flip them into a Class A type project, and you get these massive increases in rental rates. That's starting to slow, and they're going to have some difficulties meeting their projections. I think the other side as well is some of these areas that were mentioned, call it New York, Washington, D.C., Houston, Dallas. um, you know, there's robust demand in those markets because they're primarily renter markets. You step outside New York, step outside DC, and some of these areas, and you're in the suburbans where people are buying houses. They're not as, not necessarily renting as much as when you're in those direct urban sprawls. So, I think the reality is that there's still good deals there, and there's still good opportunity, and something we should continue to look at and will continue to look at. But I think the other side is, you're going to see opportunity because people, like they always do in all these, I don't want to call them bubbles, but in these down markets or apparent down markets, the media is telling us there's going to be opportunity to buy.
Yeah, I think that's a great point. I think back before the Fed started hiking rates and you had a Fed funds rate at close to 0%, you had a lot of cheap money out there, and there were some operators that really kind of modeled projects on really low interest rates and just weren't prepared to either refinance at higher rates when they had to, or maybe they actually took adjustable rates and were just assuming that things weren't going to go higher. And for those operators that bought good properties with bad financial models, there could be an opportunity for folks like us to come in and get some good buys because the property is decent, but the model just doesn't work. Uh,
Well, I mean, and
yeah.
the other side you gotta add to it is back to the workforce housing side. When the cost of debt was low, prices were through the roof, and now the prices are coming down a little bit, but the cost of debt is still through the roof. Or sorry, is switched, and now it's through the roof. Parent roof to people today. Whereas you look at the historic high, and this isn't anywhere near it. But to me, that add that in with the lack of inventory, or at least stale inventory that's out there for people to buy. They're looking to rent still, and people still like some of that ability to rent somewhere for a year and move somewhere else.
Yeah, I think that's a great point because that's a trend we saw before a lot of people were talking about it. We've invested on that trend. We think that's still a trend you can invest on, and that is there's this demand for affordable housing. We're not talking subsidized housing, but workforce housing, housing that's not luxury, apartments, but there's not enough units for it. And people aren't building those units because a lot of times developers come in and they see the cost of labor, they see the cost of construction, and they want to get the highest, price they can per square foot. So they go for the more the luxury end. So we've got really a shortage of quality Class C out there. And it might not sound sexy, but there's definitely a place in the market where we see some good opportunity to make some money with the right projects.
Well, it's funny you say that because real estate isn't about it being sexy. It's about getting a return.
Exactly, exactly. But I also don't want to, be too negative on the high end,
No, not at all.
because the other thing we're seeing with the higher mortgage rates, residential housing still very expensive, is that there's still a lot of folks who would like to buy that aren't buying just because it's just not affordable or they don't see it as a good deal and they're renting instead. So even the high end is actually holding up pretty well. I would say, yeah, there's some local markets that are having challenges. You have to look at your metros. There's some individual properties, and there's definitely some operators that just modeled badly and weren't prepared for higher rates. But by and large, this is a sector that's still got a lot of opportunity in it, and it's still doing pretty well.
Well, I mean, let's bottom line it. You didn't say that you're getting rental rate decreases. You're just getting a slower increase. So that being 3%, it's 0.6%. Doesn't mean it's bad. Doesn't mean it went negative. It's growing still. It's just slowing down.
Okay. Hey, I appreciate it, Jeff. Thanks a
Thanks,
lot.
Steve.